You're with Power Lunch here on NDTV Profit, and 71.31 right now on the Nifty 50. The CAC 40 down 0.75%. The FTSE 100 down 0.6%, despite a negative Q coming in from European markets. Our benchmark indices have actually recovered some of the lost ground. It's marginal, but just taking note of it. 71.31 on the Nifty 50, as I mentioned, and 23,486 on the Sensex, now down 1.25%. That's the market summary for you. But all this week, building up to next Monday, the focus is on what the union budget will deliver this time round. In our knowledge series, powered by BMR Associates, today I'm very pleased to welcome Shefali Goradia, partner at BMR Associates, to focus on what the financial services sector, A, expects from the budget, and B, is likely to get from the budget. Shefali, thanks very much for joining us this afternoon on NDTV Profit. We've spent the last couple of months really talking about banks and recapitalization needs and provisions. But before we get into those kind of details, the overall tone that you expect this budget to set when it comes to the financial services sector, what are your expectations?
So our key expectations would be that the FSLRC recommendation of the new financial code needs to be implemented in a time-bound manner. We need to see some follow-on actions from the government in putting out the operational framework and the financial framework for the GIFT City. This would be an extension of the Make in India movement that the government has launched, where it could be extended to, increasing the activities in the financial services sector in India by making it an attractive financial proposition for many of the offshore activities to be moved onshore. So if the government chooses, there is a lot that they can do, and a lot of follow-on actions on the reforms which have already been announced in the past should be looked out for.
Okay, so let's get as granular as we can, and I'm just going to go one by one, and forgive me if I sound a shade repetitive in my questions, but when it comes to the policy and reform side, on your checklist, there are expectations perhaps or hopes that there could be a separate investment window for, more pedigree investors. Throw some light on why that expectation is critical.
So clearly, I think government needs to do more to kind of revive the sentiment for the capital market. So it would certainly help if a new window is set out for some of these pedigree investors. Not only that, but just, some more action on the part of the government to bring in more stability in the tax regime for the foreign portfolio investors would be good to see. The clarity that we need on implementation of MAD or applicability of the minimum alternate tax to the FIIs, that would be in order. The government has already announced that, but that needs to be made a part of law, that MAT will not apply to the foreign investors that do not have any place of business in India. Besides that, some more action on the front of the transaction taxes would also be in order. I think it is quite known that many of these businesses have been moving offshore because of the high level of transaction taxes, such as the securities transaction tax on derivatives or the commodities transaction tax. And any reduction or relaxation in that will kind of revitalize the derivative market for India.
Okay, so you're saying, just review the transaction taxes, the securities transaction tax, the derivatives transaction tax. I'm going to come back to the big picture before we talk a little bit more in detail about the direct and indirect tax approach that the financial sector needs. The Bankruptcy Code, again, critical piece of legislation. I don't know how much time we should spend talking about it. It really depends on how smoothly Parliament functions. But take a moment to reiterate the importance of it.
Absolutely. There has been the growing concern more than ever on the non-performing assets in the bank's portfolio. And it cannot be underemphasized that today is the day, where we do want to see some more action on the part of the government to address these needs for the bank. It means we need to see the Bankruptcy Code being passed so that there is a framework to facilitate additional funding to go in and for the businesses to make an investment in buying out the non-performing portfolio from the banks. In the last budget, the government had announced that SARFAESI would be extended to the NBFCs with, say, the asset base of more than 500 crores. But we haven't seen any further follow-on action on that. And even some more action on the part of the government on applying the SARFAESI provisions to the NBFCs would also make the debt restructuring somewhat easier.
What about the capitalization of the banks themselves? I mean, there is talk in the budget that we could get perhaps a number, but you're looking for a more definite roadmap. Throw some detail there.
So even on the capitalization, again, I think the caps that we have on the investments to be made by the foreign investors could be increased. I think currently, there is severe bottleneck in terms of funding. And if we are able to raise the limit up to 49%, I think that would see a lot more capital being infused.
Okay, and when you say that, do you say that from an ideal academic point of view, or because you already have a sense that the government is thinking along these lines? Because that would be a pretty bold move, Shefali, wouldn't it?
It would, but it has been called for since a long time. And today, if you see, there is already a need being felt for augmenting the risk capital in the economy. And where is this capital going to come from, right? So while on the private side, we need to do something more to the infrastructure and the ecosystem for the angel funding that goes into certain, risk industries. At the same time, we also need to facilitate more institutional funding to go into the financial investors, such as banks or NBFCs. Now, in banking sector, of course, the foreign investment has its already the limits which are, very almost reached in all cases. So therefore, unless and until there is some more relaxation, we won't see the new interest or the revived interest in putting more funds. And if the banks had additional money to invest, they could then invest into the ARCs or a certain category of AIFs, which could then channelize some more funding into this sector.
Okay. I'm going to ask you this question in a slightly different way. You've already sort of highlighted the need for, clarification from the government that MAT will not apply to foreign investors. You've touched upon, the securities transaction tax and similarly on the derivative side as well. But if I ask you have a wide client base, and when we say financial services, we're talking about everything from banks to NBFCs to, payments banks to insurance firms. But through the direct tax lens, pick 3 realistic expectations that the sector has that this budget must deliver, which will actually energize the space.
So I would say that in the financial service sector, I would focus more on the venture capital funding, since the startups, are the center of attention for the government right now. Probably AIFs are the closest to the startups because they are the ones who are providing the funding. The Narayan Murthy Committee on the Alternative Investments has already made recommendations about moving on to the next practices where the tax and the regulatory framework for the AIFs can be improved. So, for example, if the pass-through status which is currently available to the Category 1 and 2 AIFs can be extended to Category 3, or the withholding tax on the distributions from these funds, if that can be relaxed for the exempt income and to the extent of the income being passed on to the exempt investors, I think that would go, a long way in improving the investor sentiment for investments into AIFs. The AIFs also need to be granted approval to invest overseas, because some of the startups that they've been trying to fund, while they might be India-centric, but their investment holding companies are overseas. So if we can relax that and extend the pass-through all the way up to the investors, where they are able to take credit for the expenses of the funds as well as for the service tax which is borne by the fund, that would really go a long way.
So, AIFs, alternate investment funds, are sort of the backbone on which, the whole startup movement that Prime Minister Modi is advocating rests. That aside, insurance, for example, again, on the direct tax side, anything that you'd like to flag off, which is a must-do?
So I would say that on the fund side, again, I would stay with the funds because, most of the money is coming from there.
Okay.
And on the offshore fund side, there is this concern about the indirect tax being applied to the investors.
Okay.
So when the investors in a foreign fund, be it an FII or be it a private equity fund, when they exit, whether they would be subject to an Indian tax. And this is, the typical Vodafone kind of tax, which is levied at the offshore level because the fund derives value substantially from investments in India. There is already an exemption offered for the investors who have less than 5% stake in the fund. But this needs to be extended fully to all portfolio investors, because when they are exiting at the offshore level, there may not be a corresponding exit at the India level. So giving them this certainty that the investors will not be subject to a indirect tax when they redeem their investments from the foreign fund, that would be a good thing to see in the budget. Besides that, we've also been hearing of lately that there is this thinking in the government about changing the definition of long-term gains and extending it from 1 year to 3 years. And I would hope that this is not something that the government would rush into, because any instability in the capital gains tax regime will only push the investors more to the offshore jurisdictions such as Mauritius, where they are completely neutral to any Indian changes in the tax framework. So this is the time when we need to see more stability and more preparedness for the general anti-avoidance rule, which is likely to be announced in 2017. But before that, how do the investors how should they be arranging their structures in preparation for GAR? If there is more clarity and visibility into the situations where GAR would be applied, I think that would be a great help and will for the foreign investors to plan their affairs when they are designing the structures for investments in India.
Again, I'm going to ask you this question. It's always a tough one to answer. Sort of, how would you assess the responsiveness of the government to the recommendations that you've outlined? I mean, you do have your finger on the pulse of which way the government is leaning and thinking. Could you assess that for us?
Unfortunately, my assessment is that the government is quite busy with the optics right now. So I'm not sure, they would really be that focused on going that extra mile and providing some of the changes which are path-breaking changes. But at least even if they follow on what they have already announced, I think even that is sufficient for India to, again emerge as an attractive investment jurisdiction. So I can only hope and pray, but some movement from the government, especially with the markets, markets being what they are, I think if they can put some more weight into the reforms that they've already announced, they would go a long way.
Okay, if, there's one action that comes through in the budget which you would take as very disappointing, is it fair to say that it would be the definition of long-term gains? Capital gains?
Yes, absolutely.
Yes?
Absolutely.
Just the dimensions, address the dimensions of damage that this does for investors. And I know that, it's equally sort of disturbing from a stock market perspective as well. And you've already thrown some flavor and color of, what this does, how it pushes investors offshore. But, just let's put on the table the sentiment damage from such a move.
So you rightly put it, this is more of a sentiment damage because for the investors, they plan their affairs on the basis of certain expectation of the tax outcome. They have certain expectations that if they have long-term losses, they'll be able to offset against that. Or that if there is let's say a 0% tax cost, if they exit after 12 months, then they would not have to pay Indian tax if it is on the markets. Or that if it is, unlisted securities, then there is a 10% tax cost if they exit after 1 year, which has already now extended in certain situations. So any movement in the tax cost that plays upon the sentiment of the investors, because then they think that there is no certainty. So then they must do what it takes to protect their interest and neutralize against any future tax changes. So the investors said, at least the foreign investors, if they have the ability to move their investments offshore, they would do that. If they have the ability to invest through a treaty jurisdiction such as Mauritius or Singapore, which already offers them an exemption from any type of capital gains tax in India, then they would do that. And that goes against the whole grain of motivating the investors to all come onshore and, discouraging them from treaty shopping or taking benefits from the offshore tax treaties. So if we want to bring them onshore, then we need to show to them that India has the ability to offer them a stable regime, and once they have factored in a certain tax cost, that would not vary for the lifetime of the investment.
It boils down to that one word or phrase, doesn't it? A stable tax regime. Shefali Goradia, it's been an absolute pleasure having you share your insights and expectations for the financial services sector in Budget 2016, and we look forward to assessing what the government actually does and delivers. Thanks very much for joining us this afternoon.
Thank you. Thank you.
We're going to take a quick break. When we return, Pavan Goenka of Mahindra & Mahindra with his expectations from the budget. Stay tuned.